Warren Buffett was worth $376 million at age 50. Today, at 94, he's worth $137 billion. That means 99.7% of his wealth. Everything you think of when you hear Warren Buffett was built a FTER his 50th birthday. Let that sink in. The world's most famous investor did almost all of his wealth building in the exact phase of life where most people think it's too late. I'm going to show you exactly how he did it. Not with secret, not with genius, with 5 principles that work even better when you're 50, 60, or 70 than they do at 25. And if you think you've missed your window, this video will prove you wrong. Here's what nobody tells you about building wealth after 50. The financial industry wants you to believe your best years are behind you. That if you didn't start investing in your 20s, you're screwed. That compound interest only works if you have 40 years. That's not just wrong. It's the opposite of true. Buffett's story proves something radical. Time is your advantage, not your enemy, if you know what you're doing. In the next 19 minutes, I'm going to walk you through 5 things. First, why compound growth actually accelerates when you have experience and emotional discipline. Second, the 5 principles Buffett used to turn $376 million into $137 billion between ages 50 and 94. Third, real math, not fantasy, showing what's possible starting today at 50, 60, even 70. Fourth, the 3 fatal mistakes that destroy wealth after 50 and how to avoid them. And fifth, a simple framework you can implement this week, not in some theoretical future. This isn't theory. Every number I'm going to show you is documented. Every principle is proven across multiple crises: the 1987 crash, the dot-com bubble, the 2008 financial crisis, COVID. Buffett lived through all of them, built wealth through all of them. And if an 80-year-old can survive the worst financial crisis since the Great Depression and come out richer, you can start at 50 and win. Let's get into it. Everyone knows the compound interest formula. $1,000 at 8% for 40 years becomes $21,724. What they don't tell you, compound interest doesn't care when you start, cares that you don't stop. Buffett understood something counterintuitive. Starting at 50 gives you advantages that 25-year-olds don't have. You have capital. You have cash flow. You have no kids to put through college. You have emotional scars from past mistakes that make you cautious. You've lived through recession. Most importantly, you're investing for 30 to 40 years, not 5 to 10. If you live to 85 or 90, which is increasingly common, you have 3 to 4 decades of compound growth ahead. Buffett was 50 in 1980. He's 94 now. That's 44 years of compounding. He didn't slow down. He didn't retire his money. He let time do the work. Let me give you an example. 2 friends, both 50 years old in the year 2000. Let's call them Robert and Susan. Robert thinks, I only have 15 years until retirement at 65. Not enough time to build real wealth. I'll just save in a savings account. Susan thinks, I have 30 plus years of life expectancy. Let me invest like I'm building for 3 decades, not 3 years. Both have $100,000 to start. Robert's approach keeps money in savings account, CD, average 3% return, safe, conservative. Susan's approach invests in index funds, the S&P 500, average 10% return over 24 years from 2000 to 2024, holds through the dot-com crash, 2008 crisis, COVID. The result in 2024, when they're both 74, Robert, $100,000 times 1.03 to the power of 24 equals $203,279. Susan, $100,000 times 1.10 to the power of 24 equals $987,356. The difference, $784,077. Same starting amount, same 24 years. Robert treated it like short-term money. Susan treated it like Buffett, a long-term compound machine. The lesson, your time horizon determines your returns. If you're 50 and healthy, your time horizon is 30 to 40 years, not 10 to 15. Invest accordingly. Let's get personal. If you're 55 today, your life expectancy is 82 to 85 years, the USA average. That's an investment timeline of 27 to 30 years. Warren Buffett at 55, which was 1985, had 39 years ahead of him to compound. You might have 30. That's not a disadvantage. That's more time than most people actively use. Here's a key calculation. $250,000 at age 55 with 8% annual return. That's conservative for a diversified portfolio. By age 85, which is 30 years later, that becomes $2,518,175. 10 times your starting capital. Not from genius, from not stopping. Time is your advantage, not your enemy. Buffett's biggest investments after 50 weren't sex. In 1988, when he was 58, he bought Coca-Cola, not a tech startup, a soda company that had existed for 102 years. In 2010, at age 80, he bought Burlington Northern Santa Fe Railway, a freight railroad, one of the oldest, most boring industries in America. In 2016, at age 86, he started buying Apple, but only after it had been around for 40 years and proven itself. Pattern? He invests in things a 70-year-old can understand. Here's why this matters for you. After 50, you can't afford to gamble on the next big thing. You don't have time to recover from a crypto crash or a meme stock implosion. Boring, predictable, proven businesses compound wealth. Exciting, unpredictable, revolutionary investments destroy it. Let me tell you about Michael. Michael was 62, a retired engineer with $800,000 in retirement savings in 2020. His son tells him about cryptocurrency. Dad, Bitcoin is the future. You're missing out. Michael watches Bitcoin go from $10,000 to $60,000. 2021 feels FOMO, fear of missing out. Against his wife's advice, he moved $400,000, half his retirement savings, into Bitcoin and altcoins at the peak. Then 2022, crypto winter. Bitcoin crashes to $16,000. His altcoins drop 80 to 90%. Michael's $400,000 becomes $120,000. He lost $280,000 in 18 months. Now, at age 65, he has $520,000 left. He needs to work 3 more years to rebuild a safety cushion. Meanwhile, his neighbor Linda, also 62, invested her $800,000 in 60% S&P 500 index fund, 30% dividend-paying stocks like Coca-Cola, Johnson & Johnson, Procter & Gamble, boring companies, and 10% bonds. Through the same period, 2020 to 2024, her portfolio grew to $1,100,000. Same starting point. Michael chased excitement. Linda chose boring. The lesson, after 50, boring is beautiful. You're not building wealth to impress people. You're building it to leave on. Let's look at what Buffett actually bought in his 50s, 60s, 70s, 80s. Coca-Cola in 1988, 102-year-old soda company. Gillette in 1989, Razors. People need to shave. Insurance companies like Geico and General Re. People need insurance. Burlington Northern Railway in 2010. 160-year-old freight train. Apple in 2016, only after it became the world's most valuable company. Nothing revolutionary, nothing that required a PhD to understand. His test: can I explain this business to a 10-year-old in 2 minutes? If yes, invest. If no, pass. Boring beats brilliant. Buffett says, rule number 1, never lose money. Rule number 2, never forget rule number 1. This sounds like a joke. It's not. Between ages 50 and 94, Buffett lived through 1987. Black Monday. The market dropped 20% in one day. The 2000 to 2002 dot-com crash. The Nasdaq fell 78%. The 2008 to 2009 financial crisis. The S&P 500 fell 57%. And the 2020 COVID crash, a 34% drop in 1 month. His strategy? He survived all of them without panicking. Berkshire Hathaway stock dropped 50% in 2008 and 2009, from $150,000 per share to $70,000. Buffett didn't sell. He held. By 2024, Berkshire is at over $600,000 per share. Survival beats optimization. After 50, you can't afford to lose 50% of your capital and spend a decade recovering. Your job is to not blow up. Let me tell you about 2 men, both 58 years old in 2007. Both have $600,000 invested in the stock market. The 2008 financial crisis hit. Their portfolios dropped 40% by March 2009. They're now at $360,000. Man number 1, Tom, panics. I can't afford to lose any more. I'm 60 years old. He sells everything in March 2009, locks in his loss, moves to cash. Cash sits there for 5 years while he waits for things to stabilize. By the time he re-enters in 2014, the market has already doubled. Man number 2, David, holds. Doesn't check his account for 6 months. His philosophy: I'm not retiring until 68. I have 10 years for this to recover. The result in 2024, Tom sold at $360,000 in 2009, re-entered at around $450,000 equivalent in 2014. With conservative returns, he's now at around $850,000. At age 75, David held through the crash. $600,000 in 2007, dropped to $360,000 at the 2009 bottom, back to $600,000 by 2012, and now $2,150,000 in 2024 at age 75. The difference, $1,300,000. Same starting point. Tom tried to protect his money. David trusted the principle of survival through holding. The lesson: the crash is the test. Your behavior during the crash determines your wealth after it. Here are Buffett's survival rules after 50. 1. Keep 1 to 2 years of living expenses in cash. You never have to sell stocks in a crash. Cash is your emotional buffer. 2. Never use leverage, borrowed money, to invest. Leverage forces you to sell at the worst time. Buffett says, when you combine ignorance and leverage, you get interesting results. 3. Own businesses that survive recession. People still drink Coke in a recession. People still need electricity, insurance, food. 4. Don't check your portfolio during crash. Seriously, log out. Go for a walk. Buffett says the stock market is a device for transferring money from the impatient to the patient. Let me show you the math. Let's say you're 60 with $500,000 invested. Scenario A, you panic sell during a 40% crash. Portfolio drops to $300,000. You sell, lock in the loss. You miss the recovery. By age 75, with conservative re-entry and returns, You have around $550,000. Scenario B. You hold through the crash. Portfolio drops to $300,000. You don't sell. The market recovers, average 2 to 4 years. Portfolio grows at 8% from the original $500,000. By age 75, you have around $1,586,000. The difference, $1,036,000. The panic sale cost you over $1 million. Survive first, thrive second. Buffett's famous quote, "Our favorite holding period is forever." He bought Coca-Cola in 1988. He still owns it in 2024. That's 36 years of holding. He bought Geico in the 1990s, still owns it. Burlington Northern in 2010, still owns it. He doesn't trade, he accumulates. Here's the math that changes everything. Every time you sell and buy something else, you pay taxes on gains to 15 to 20% federal plus state. You pay transaction fees. You reset your compound clock. Example, buy stock for $100,000. It grows to $200,000 over 10 years. You sell, pay 20% capital gains tax. That's $20,000. You reinvest $180,000 in something new. You just lost $20,000 of compound fuel. If you'd held for 20 more years, that $200,000 at 8% becomes $932,000. But you sold and paid tax, so you only have $180,000 to reinvest. At 8% for 20 years, that's $838,000. Cost of selling, $94,000. Now multiply that by 5 to 10 trades over a lifetime. You've destroyed hundreds of thousands in compound growth. Let me tell you about two brothers, both 52 years old in 2010. Both inherit $400,000. Brother number one, Jake, thinks he's smart, starts day trading and active management, buys and sells stocks based on news, trades in and out of sectors, takes profits when stocks go up 20 to 30%, average 15 to 20 trades per year. Brother number two, Paul, is a Buffett disciple, buys an index fund, goes to sleep, puts $400,000 in S&P 500 index fund in 2010, reinvests dividend, checks it once per year, makes 0 trades. The result in 2024, when they're both 66. Jake, after taxes, fees, an emotional mistake, selling winners too early, holding losers too long, has an average annual return of around 5.5%. Research shows active traders underperform by 3 to 5% annually. His portfolio value around $830,000. Paul, simple index fund hold, S&P 500 return 2010 to 2024 was around 11% annually. His portfolio value around $1,680,000. The difference, $850,000. Paul made double what Jake made by doing nothing. The lesson, activity is the enemy of returns. The more you trade, the poorer you get. What Buffett looks for, a business that will exist in 30 years, a competitive advantage, brand, network, regulation, management he trusts, a reasonable price. Then he holds forever. His Apple investment started in 2016. Initial cost, around $35 billion. Value by 2024, around $160 billion. He held for 8 years. If he'd sold after the first year or two, he'd have missed over $100 billion in gain. Let me show you the power of holding. Let's say you're 55 with $300,000 to invest. Scenario A, you're a trader, 10 trades per year. Each trade triggers taxes and resets compound. Average return after taxes and fees, 6%. By age 80, which is 25 years later, you have $1,287,000. Scenario B, you're a holder. 0 trades, buy and forget. Same stocks just held. Average return 10%, no tax drag, no fees. By age 80, you have $3,254,000. The difference, $1,967,000. Doing nothing made you $2 million richer. Hold, don't trade. Buffett says the stock market is a device for transferring money from the impatient to the patient. By the time you're 50, you've lived through enough to know markets crash. Always have, always will. The difference between winners and losers after 50 isn't intelligence, it's emotional control. Buffett was 78 years old during the 2008 financial crisis. His net worth dropped from $62 billion to $37 billion in 1 year. He lost $25 billion on paper. Did he panic? No. He wrote in his 2008 letter, "A simple rule dictates my buying. Be fearful when others are greedy, and greedy when others are fearful." In the middle of the crisis, he was buying, not selling. Why could he do this at 78? Because he'd survived the 1973 to 1974 crash at age 43 to 44. 1987 Black Monday at age 57. The 2000 to 2002 dot-com crash at age 70 to 72. Experience equals emotional discipline. You're 50 plus, you've lived through crashes. That's your superpower. You know the world doesn't end. Let me tell you about Grace. She was 63, a retired university professor. In 2007, Grace wasn't wealthy. She'd been a professor for 40 years. Her retirement savings, $420,000 in a diversified portfolio, stocks plus bonds. The 2008 crisis hit. Her portfolio drops 38% to $260,000. Her friends panic. "Grace, you need to sell. You're 64. You can't lose everything." Grace's response, "I don't need this money for 10 years. I'll check back in 2018. She literally stopped checking her account. Meanwhile, her friend Barbara, same age, same starting amount, sold everything in March 2009. "I can't watch it drop anymore." The result in 2024. Grace held everything. $420,000 in 2007 dropped to $260,000 at the 2009 bottom, recovered by 2013, continued compounding at around 9% average. At age 80 in 2024, she has around $1,450,000. Barbara Panic sold in 2009, sold at $260,000. Sat in cash for 4 years, waiting for clarity. Re-entered in 2013 at higher prices. Conservative returns afterward. At age 80 in 2024, she has around $550,000. The difference, $900,000. Grace's secret weapon? She forgot her password. The lesson, ignorance of daily fluctuations is bliss. Emotional discipline isn't about being brave. It's about being absent during the storm. Here are Buffett's rules for staying calm. He says, "I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. Translation, if you need the money in 5 years, don't invest it in stock. Risk comes from not knowing what you're doing. Translation, only invest in things you understand. Successful investing takes time, discipline, and patience. Translation, if you're impatient, you'll fail. Here's what nobody tells you. Being 50 plus makes emotional discipline easier. Why? You've seen crashes before. You know they end. You're less impulsive. Your brain's prefrontal cortex, the impulse control center, is fully developed. You have perspective. You've lived long enough to know that this too shall pass. 25-year-olds panic and crash because it's their first crash. You're 60, it's your 4th or 5th crash. That's an edge. Let me show you the cost of emotion. You're 58 with $600,000 invested. A 40% crash happened. Portfolio drops to $360,000. Option A, panic sell. Emotional reaction. Sell at $360,000. Miss recovery. By age 73, which is 15 years later, with conservative reinvestment, you have around $720,000. Option B, do nothing. Discipline. Hold through crash. Market recovers. Historical average 3 to 4 years. Portfolio compounds at 8% from original $600,000. By age 73, you have around $1,900,000. The difference, $1,180,000. Your emotions just cost you over $1 million. Emotional discipline is everything. Now let me tell you what not to do. This is the most deadly mistake after 50. You think, I started late, so I need to take bigger risks to catch up. You invest in high-risk stocks, crypto, options, and leverage. Hot tips from friends. Let me tell you about Tom. He was 61 with $300,000 in retirement savings in 2020. Felt he was behind because his wealthier friends had millions. Decided to catch up fat by trading options in meme stock. GameStop, AMC, made $150,000 in 6 months. Felt like a genius. Got overconfident. Invested more aggressively. Lost $220,000 in the next 12 months. At age 63, he's back to $230,000. He destroyed 5 years of progress. The alternative, if Tom had just invested that $300,000 in an S&P 500 index fund from 2020 to 2024 and done nothing, he'd have around $510,000 today. Instead, through trying to get rich quick, he has $230,000. The rule, after 50 you can't afford to gamble. Slow and steady isn't boring. It's survival. The yield trap. You see an investment offering 8, 10, 12% annual dividend. Your current portfolio yields 2 to 3%. You think, I need more income in retirement. I'll switch to high yield. The problem, high yield often means high risk. Let me tell you about Susan. She was 66, retired with $800,000 in 2019, switched her entire portfolio from index funds to high-yield investments, REITs, real estate trust, high-yield bond fund, dividend stock. Many were oil and energy companies. Was getting 7 to 8% income. Felt great. Then COVID hit in 2020. Oil crashed. Real estate crashed. High-yield bonds defaulted. Her high-income portfolio dropped 52% from $800,000 to $384,000. The income disappeared because companies cut dividend. The result, at age 70 in 2024, after partial recovery, she has around $550,000. Contrast, her sister Linda, same age, same starting $800,000, stayed in a boring S&P 500 index fund. Lower dividends, 2%, but stable. Her portfolio dropped 34% in COVID to $528,000, but recovered fully by 2021. By 2024, Linda has around $1,150,000. The rule, don't chase yield. Focus on total return, growth plus income, not just income. The waiting trap. You're 60. You have $400,000 to invest, but you think the market is at all-time highs. I'll wait for a crash, then invest. The problem, the market is at all-time high most of the time, 70% of days historically. Let me tell you about David. He was 58, sold his business in 2013 for $500,000. Thought, stock market is too high. S&P 500 at 1,800. I'll wait for a crash. Waited 2014, 2015, 2016. No crash any day now, he thought. Waited 2017, 2018, 2019. The COVID crash finally came in 2020. He was vindicated, but he was too scared to invest during the crash. What if it crashes more? By the time he invested, late 2021, The market had already recovered. He bought in at S&P 500 equals 4,500. The result in 2024, David's $500,000 sitting in cash for 8 years from 2013 to 2021 grew to maybe $520,000. Inflation adjusted, he lost value. Contrast, his friend Maria invested $500,000 in 2013. Immediately, despite crashes, pullbacks, and volatility, by 2024, she has around $1,450,000. The rule, time in the market beats timing the market. Always Buffett's word. The stock market is a device to transfer money from the active to the patient. Now, let me show you real math for real people. Conservative approach, 8% average annual return. That's lower than the historical 10% of the S&P 500. You don't add new money. You just hold. The results, age 65, which is 10 years, $539,731. Age 75, 20 years, $1,165,317. Age 85, 30 years, $2,518,175. If you add $1,000 per month, age 65, $745,421. Age 75, $1,830,543. Age 85, $4,144,673. Conservative approach, 7% average annual return. That's very conservative. You don't add new money. The result, age 70, 10 years, $983,575. Age 80, 20 years, $1,934,842. Age 90, 30 years, $3,806,127. Your retirement is protected. You leave an inheritance. Starting amount, $50,000. Monthly addition, $2,000. Return, 8%. The result, age 60, 10 years, $428,451. Age 70, 20 years, $1,324,089. Age 80, 30 years, $3,144,557. This is not fantasy. This is math. Person A starts at 25, invests $500 per month for 40 years, 8% return. Total invested, $240,000. At age 65, they have $1,745,503. Person B starts at 50, invests $2,000 per month for 15 years, 8% return. Total invested, $360,000. At age 65, they have $693,289. Yes, person A has more, but person B invested for 15 years and built nearly $700,000. That's not failure. That's success. Remember, age 50 in 1980, he had $376 million. Age 94 in 2024, he has $137 billion. Time, 44 years. Compound annual growth rate, around 14.8%. You don't need 14.8%. You need 7 to 10% in time. That's it. Let me bring this home. Warren Buffett built 99.7% of his wealth after age 50. Not because he got lucky, not because he had a secret formula, because he understood 5 principles. 1. Time is your advantage, not your enemy. You have 30 to 40 years of compound growth ahead. 2. Boring beats brilliant. Invest in businesses a 70-year-old can understand. 3. Survive first, thrive second. Don't blow up your portfolio chasing return. 4. Hold Don't trade. Every trade resets your compound clock and triggers taxes. 5. Emotional discipline is everything. Panic is more expensive than any market crash. Let me tell you about Ronald Reed. He died in 2014 at age 92. He was a janitor and gas station attendant his entire life. Never made more than minimum wage. When he died, his estate was worth $8 million. How? He started investing in his 60s, bought dividend-paying stock, held them forever, never sold, reinvested dividend, blue-chip companies, J.M. Smucker, Procter & Gamble, CVS, Johnson & Johnson. Boring stock, held for 30-plus years, $8 million from a janitor who started at 60. Meanwhile, in the same town, a wealthy lawyer who made $300,000 per year declared bankruptcy at age 65. He spent it all, tried to time the market, chased hot stock, same town, same time frame, different philosophy, different outcome. If you're 50, 60, even 70, this is not the end. This is the beginning. Buffett proved it's not about when you start. It's about not stopping. You have time. You have experience. You have emotional discipline from living through past mistakes. Those are advantages 25-year-olds don't have. The question isn't, is it too late? The question is, will I start today? Because 20 years from now, you'll wish you had. Someone sitting in the shade today because someone planted a tree a long time ago. Plant your tree today